on WBRN Radio and on the Bostonred Network. This is the Numbers Man Show, as it's now called. And nonetheless, we're on the second day of January 2020, and we're looking back at 2019. I'm not certain at this point in time how we are going to title this particular episode, but nonetheless, it is the week's broadcast. We're putting forward here that 2019 ended with the market up, and we'll give those statistics here. We'll start off with the latest from the conference board. We normally fall back upon them, and we also have some trade numbers here, and from the people at IBS HBS market, we have one of the PMIs. I believe it's the Russian Federation PMI. I'll have to look over here in a minute. But in general, equities, the stocks were up during 2019. There was obviously some bumps along the way there with the inverse curve being in the bond market. We'll give those bond numbers also where that ended up. And from listening to many analysts, including some polled by Reuters, as to what went on and what that bodes for 2020, it's up in the air, basically speaking, but we are seeing some weakness with the consumer sector, which is over 70% of the American economy. Those are some things that are coming out loud and clear. Now, as far as expansion and depression in 2008 and 2009, the economy started to expand. That's basically been about 10 years, or a decade. And does expansion in a modern capitalist society continue? Well, there are a lot of things that, and that's not very economic to say things, but there are a number of conditions, we'll say, that cause problems. If you recall, in 2019 and 2018, there was a massive tax cut, which provided artificiality to the economies, some types of stimulus, at least from a psychological point of view. The reduction, of course, in corporate taxes. And what did the corporations do with their taxes? Well, they bought back some of their stocks. Thus, on those buybacks, they increased as to where they would have normally been. And we got 2,800 plus, I say we, in terms of the U.S., and that in itself is a very interesting situation. At the same time, the central bank in the U.S., it's the Federal Reserve, raised interest rates, which they should have done, and then they raised them 4 times, and then they lowered them 3 times, which they should have not done, at least in our opinion. But nonetheless, that is where the status of the economy is at this point in time. And where did the tariffs enter into this? Well, that's kind of up in the air also. There was a federal program for farmers that were hurt, and that program amounted to billions of dollars. In fact, there was more money spent on that program than saving Detroit, when Chrysler and the other automobile makers were on the verge of bankruptcy, and some did in fact go through bankruptcy. And a political decision was made to lend them the necessary funds to continue. Thus, it was Daimler Chrysler at the time, no longer Daimler Chrysler, but Chrysler is still in business. GM is still in business, and they are all profitable. The automobile industry is back, although automobiles do not sell at the pace they once did. So in other words, a changing landscape with consumers, and also the cost of these motor cars, the SUVs or what have you, Now it's a 5, 6, or 7 year payment plan out there that people have to pay these pollution units off. So we see that coming in there as one of the big situations. Of course, mortgage rates being low, the qualification for these loans is much more stringent than it was, and that has created somewhat of a problem, and also the supply due to the exit of many of the skilled construction workers in single-family housing, went out during the Depression and never returned. Thus, it's hard to find skilled crafts types to do much of the work. And, of course, the effect of immigration policy also has dried up the so-called pool, scarcity of land and other things. And 2019 was a year that climate became a much more important situation in the UK. They are now literally stressing banks under the central bank, in the Bank of England, to see how they would perform in various natural, as they call them, disaster scenarios. The former head of the Bank of England, Mr. Carney, will now be with the international UN program on climate, and sending the message to large corporations that they now have to factor climate into their outlooks. So climate went from the streets to the banks, so to speak, or the suites, or whatever they want to call it. You have Greta Thunberg and her one person outside of the Swedish Parliament, and now appearing before hundreds of thousands and millions of people. It's a nationwide thing. So now it's got into the economic system. In Australia, they have the bushfires. We don't have any numbers on the economic damage, but it is into millions of Australian dollars that has there, and the conservative government there has recognized that climate does play a role. And this is very interesting, and on the political side, that many of the fossil type of corporations funded, encouraged, etc., lobbied the governments to keep their fossil type fuels in as part of the economic landscape, whereas many more sustainable and solar, wind, etc., has come in. In Australia, you have mining. That's an old industry. It's been around forever. And they are also number one or two in liquefied gas. So those are things that are causing problems in the environment there. It's literally burning the place down. Thus, the changes have to be made, and comments by scientists that the whole idea of having sustainable policies, they have went beyond. So when you hear the basic 10-year window from 2020 to 2030, and this whole idea of being carbon neutral, that definition is changing. And what you will see in 2020, this year on, that these major corporations will be tested by not only their stakeholders, stockholders, what do you want to call it, but by the general public. So the Exxon people are not the only people now that are being looked at or scrutinized by the people. And in the U.S., as far as coal is concerned, it lost out to natural gas in the marketplace. So natural gas is there. The coal mines are going bankrupt. That doesn't necessarily mean there'll not be some coal mines around, but greatly reduced. It's unfortunate for the United Mine Workers Union, but as many trade unions, they are starting to move to representing not only miners but other workers. So we're seeing more and more of that. And in some countries, South Africa, for instance, China, coal mining is still there. But what does happen in terms of economy or in terms of climatic conditions, they always tend to be worsen much more severely and quickly than the latest prognostications. Models now are getting to be better, but as a case, Australia, a very large, as a country, as a continent, very large place, and have had brush fires forever, but not with this great intensity. And of course, they're in the summer now, 40 degrees Celsius, which is over 100 degrees Fahrenheit, 40 plus, I should say. So very hot conditions. It's sort of like the desert of the American West. But again, it's a different situation in the American West. We would highlight that. But let's go to the conference board now and look at the latest conference board in New York. It's been around for a very long time. This is a confidence index decreased marginally in December. I'm reading from there. Following a slight increase in November, the index now stands at 126.5 from 1985 equals 100, down from 126.8. An upward revision in November. The present situation index, based on consumers' assessment of current condition in labor markets, increased from 166.6 to 170. The expectation index, based on consumers' short-term outlooks for income, business, and labor market conditions, decreased from 100.3 last month to 97.4 this month. Consumer confidence declined marginally in December, following a slight improvement in November. This is from Lynn Franco, Director of Economic Indicators at the Conference Board. While consumers' assessment of current conditions improved, their expectations declined, driven primarily by softening in their short-term outlooks regarding jobs and financial prospects. While the economy hasn't shown signs of further weakness, there is little to suggest that growth and in particular consumer spending will gain momentum in early 2020. We're of course in a Q1 now of 2020. The monthly consumer confidence surveys based upon probability design random sampling conducted by by the conference board for the conference board by Nielsen, a leading provider of information and analytics around what consumers buy and watch. The cutoff date was December 13th, so that was before the final Santa days. Consumer appraisal of current conditions improved in December. Those claiming business conditions are good was virtually unchanged at 38.7%. Those claiming business conditions are bad decreased from 13.6 to 11.1. Consumer assessment of the job market was mixed. Those saying jobs are plentiful increased from 44% to 47%. However, those claiming jobs are hard to get also increased from 12.4 to 13.1. Consumers were moderately less upbeat about the short-term outlook. The percentage of consumers expecting business conditions will improve over the next 6 months increased slightly, 18.6 to 18.9, while those expecting business conditions will worsen declined from 11.4 to 9.3. Consumer outlook on labor market was mixed. The proportion expecting more jobs in the months ahead decreased from 16.5 to 15.3, while those anticipating fewer jobs increased from 13.4 to 14.9. Regarding their short-term income prospects, the percentage of consumers expecting an improvement declined from 22.9 to 21.1, while the proportion expecting a decrease rose from 6.2 to 7.7. So that is the Consumer Conference Board survey of what we have now. The Michigan people no doubt will follow, and we'll start to look at where consumers are in the scheme of things. Let's go now to the where we want to go, Bureau of Economic. We also have China in the mix here, but we want to go the Bureau of Economic Research. Whoops. Here we are. This was a release on the 27th of December, international investment position. Now this is part of it. The the U.S. net international investment position, the difference between U.S. residents, foreign finance assets and liabilities was 10.95 trillion at the end of Q3 of 2019, according to the Bureau of Economic Analysis. Assets total of 28.6 trillion and liabilities were 39.21 trillion. So we're dealing in trillions. At the end of Q2, the net investment position was 10.61 trillion there. There was a negative 38.1 billion change in net investment position for the second quarter. To the third quarter came from net financial transactions of 39.8 billion and net of changes in positions such as price and exchange, a negative 298.3 billion. This is kind of dry stuff here, but nonetheless we put it out here for the people. And we look at it, quarterly change in U.S. net, the international investment position, and we basically gave those where they are in the trillions of dollars. Here, U.S. assets increased by 286.8 trillion for a total for a total of $28.62 trillion. That's a very large economy, has been growing, and the liabilities increased by 624.9 billion, a total of $39.21 trillion. Portfolio investment liabilities increased by 223.1 to 20.87 trillion, driven by foreign purchase of U.S. debt and securities, bonds, etc. And the next report we'll get on this will be on the 31st of March 2020. That'll be for Q4 and the year of 2019. We'll get that from the people there. And let me just give the definition here. The international investment position is a statistical balance sheet that presents the dollar value of U.S. financial assets and liabilities with respect to foreign residents at a specific time. The BEA presents statistics at the end of a quarter or a year, and of course that is laid out there so people understand what is happening here. U.S. net international investment position is defined as the value of U.S. assets less the value of U.S. liabilities. Financial transactions are transactions between the U.S. residents and non-residents in financial assets and liabilities. They are all so recorded in the financial account of international transaction accounts. So some of the things here that are brought out in this particular situation here: exchange rates in value of foreign currency denomination assets, liabilities due to changes, change in volume and evaluations. Anyway, we won't get into all of that, but some of the things that are going on here. And release and update schedules, related statistics. You can go there and find a lot of of statistical items here, and we use some of these in our model at Crescent Analytics. That we pull this stuff down has been our tradition, or what they now call scraping of this material and using it. And it is there, and it's paid for by your taxes. And of course, we encourage people to use these particular items. You just transition off here to the UK. The UK minimum wage rises to 6.2% in April of this year. Not a lot going on here, period. This is sort of a roundup here of UK information. It won't go much into it, but what we'll do now is we will move immediately here to a CNBC. We'll start looking at some of these. This is China. Wait a minute before we do that. The 10-year U.S. bond was at 1.887. In Germany, they were at a negative 0.249. In Japan, just not. One way of putting it there, those readings and where they are standing, we'll give that in a minute here. Let's get to petroleum pricing as one of the things we'll look at here. Petroleum or petrol prices, this is from Reuters. Oil prices studied on the last trading day of the decade. And this is, of course, a decade report on Tuesday, and we were tracking for monthly and annual gains supported by thaw and prolonged China-U.S. trade dispute. Incidentally, DJ Trump has announced that on the 15th of January he'll sign phase 1 of the trade situation. Nonetheless, Brent crude was up by 9 cents at $66.79. West Texas Intermediate at $61.66 was down 2 cents. Brent has gained 24% in 2019, and West Texas has risen at 35%. Both benchmarks are set for the biggest yearly gain in 3 years, backed by breakthrough in China talks. And output cuts pledged by OPEC. Signs of progress in, well, we'll need to get to that. And we'll get into the Chinese purchasing index. We'll get into it a little bit more. That is there. PMI was unchanged at 50.2 to 50 mark is there. Looking ahead, U.S. crude inventory is expected to fall by about 3.2 million barrels in the week to December 27, third consecutive weekly decline. This is a Reuters situation here. I don't know if we have the count. And let's see, the U.S. Energy Information Administration expects average prices will be lower in 2020 than in 2019 because of rising inventories. Outside the U.S., production is expected to continue to grow in Brazil, Norway, and Guyana. So that is the position there. And let's switch over here. Now we'll come back on 2020. This is from Bloomberg. We do sort of move it around a bit here, and we'll go to China and CNBC. We'll look at it there. The official Purchasing Managers Index for manufacturing, we already gave that at 50.2. According to that, Reuters economists had expected December to be at 50.1 tenth, at 50.2 tenths. And reading above, we won't worry much about that. And manufacturing PI was 50.2 for the month of November. That's from the National Bureau of Statistics of China. The sectors for food, beverage, and so forth and so on. So robust expansion. in manufacturing activity. Even though December was the second straight month of expansion, the official manufacturing PMI economists from cautioned Nomura cautioned that the trend could not be sustained due to strong growth headwinds from cooling the property sector there. And let's go over now to China and their Bureau of Statistics. The national statistics and national economy made progress in stability in November is the big heading here, and we'll go on a little bit here on to a release, and we'll get into the release. In mid-December 2019, according to monitoring of the marketplace in 9 categories, 50 kinds of important measurements and calculations. This is in 24 provinces, and the prices of 21 kinds of products increased. And to get over here to see who decreased. And 21 kinds of increased and 23 kinds decreased, and 6 just remain the same. I won't go, they tend to go into a very detailed analysis here, and what we'll do is we'll sort of cherry pick some of these ordinary medium plate. This is metal fabrication here. Rebar, where rebar was, price change negative, let's see, 97.9, wire at a negative 100.3 tenths. The chains there, stainless steel pipe at a negative 30.1, and angle steel at negative 17.7. And non-ferrous metals anyway, agrumenium, where was it? At 1357.1, lead at 103.7. And then we get down to various chemicals. I won't go into chemicals, but they liquefied gas at a negative 43.2, liquefied petroleum gas at 302.5. In gasoline, national emission standards at 92.8. And coal is in here. I think we mentioned coal in some of these situations. Mixed, I'm not sure what mixed is here, but it was at a negative 5. And washed and medium priced coal at 9.5. And coking coal at didn't move at all. And we go down here, building materials, cement 4.6 as ordinary cement in bulk, and 5.7 flat glass at a negative 0.5 tenths there. Now we get into some of the grains, agricultural products. Rice, Japanese rice, a negative 14.3. Wheat, negative 0.9. Corn, this is the yellow time, at negative 8.2. Ginned cotton at 66. Live pigs, now this is something here at 34.7. Soybeans at a negative 1.6. That's something in the new Accord. Soybean meal at 1.3. And peanut oil. I don't have anything. Can't win them all. Fertilizer is something that people talked about. 1.9 tenths there. Compound fertilizer, negative 2.9. And forest products, no change there. Pulp, That's bleached at 1.8 temps, and corrugated paper at 71.3. And some exclamations here. Won't get into exclamations in this situation here, but basically rerun there. Let me move over here into statistics, see if this is the same thing. No. So there's more. In the first 11 months of 2019, profits made by industrial enterprises above design size achieved 5,6,110. In other words, that would be 5,610,000,000,7 yuan, in a year-over-year decrease of 2.1, calculated on comparative basis, taking into account such factors as standard adjustment according to statistical system. For the first 11 months, amongst industrial enterprise above designated size, the profits of state-holding industries gained 160.66. That's 1 trillion. It was a decrease of 11.2 year-over-year. Joint stock enterprises fell by 1.6%, and that of foreign-funded enterprises funded from Hong Kong, Macau, and Taiwan, decreased by 3.3, and the private enterprise gained an increase of 6.5. For the first 11 months, the profits of mining and quarrying reached 517.4 billion yuan, an increase of 1%. Manufacturing had a decrease of 4.1%. That of production and distribution of electricity, heat, gas, and water reached 464 billion yuan, and that was up by 17.7%. For the first 11 months, within 41 branches of industrial divisions, industrial profits of 28 divisions increased year-over-year, and 13 decreased in view of profit growth. Major industries: production of electricity, special purpose machinery, manufacturing, etc. Electrical equipment increased by 20.6, 13.6, 13.3, 10.7, 8.7, 8.3, 4.44, and 0.1 respectively. That would be other electrical equipment. Anyway, nonetheless, smeltering and precious metals, etc., mining, natural gas, they were up by 42.2 temps, 43.3 temps, and 4 temps respect, and this is what they decreased by. Anyway, for the first 11 months, revenues from activities of industrial enterprises reached 95 trillion yuan, increased by 4.4% year-over-year. The activities were 79.99 trillion yuan, up 4.6. Profit rates of revenue activity was at 5.91%, a decrease of 0.39. By the end of November, total assets of industrial enterprises above designated size was 118.89 trillion yuan, an increase of 6% year-over-year. Total liabilities reached, and this is similar to what the U.S. Bureau was doing analysis, reached 67.61 trillion yuan, something we look at here, an increase of 5.3. The total owner equity was at 51.28 trillion yuan, an increase 9. Asset liability ratio was at 56.9, a decrease of 3 tenths. By the end of November, the total note receivable and accounts receivable from industry enterprises They were at 17.91 trillion yuan and went up by 4.6 year over year there. Total inventory value of finished products accounted for 358.1 there, and that was an increase of 0.3 for the first 11 months. The cost per 100 yuan of business income above designated size stood at 84.2 yuan, an increase of 0.15 year over year there. By the end of November, revenue activities brought on per 100 yuan assets above designated size was 90.7, a decrease of 1.5 yuan. For finished goods were 17.3 days, a decrease of 0.2. That's a turnover there. In November, the profits made by industrial enterprises were 593.91 billion yuan, an increase of 5.4% year over year, while a decrease of year over year in October was 9.9%. They give a very thorough analysis here of actually where they are, and I won't go back over this particular setup here. Let's see what else. This is from Bloomberg here on China economy ends 2019 brighter with trade deal in sight, according to this. And we gave much of that information there at the 50.2. The downside non-manufacturing gauge fell to 53.5 from 54.4. China's economy begins to reaching the bottom of a cyclical downturn as 2019 drew to a close, aided by the prospects of the trade engagement, de-escalation, that sort of thing. And there's not been very much information out here, period. And basically reflects, this is from Yuki Zhu, an economist at Barclays there. He wrote, "We remain constructive on a near-term recovery, and the central bank will likely announce a cut in the bank ratio there. The economy still faces strong headwinds." He's talking about headwinds, talking about the Chinese economy here. And some economists here, according to Bloomberg, had thought the PMI would decrease there. Signs given since November that the deceleration in the economy was reaching an end for now. Infrastructure investment will likely recover at the start of the new year. Actually, today exports could get a lift on some roadblocks there. Consumption will receive support in 2020, no doubt about that. The downside factors: rebound infrastructure investment could be challenged as local governments' fiscal power remain tight and off-balance sheets there. Robust credit growth may have been overstated. Small banks, local governments financing vehicles face a relatively high financial risk. Well, obviously, that is one of the things to come. Let me just go back here. This is Bloomberg on 2020, a good place to be. 2020 U.S. Market Field Guide, 5 keys here. A new decade has dawned. If anything, 2019 was a year on the edge. It started with a government shutdown, then a fear of recession dominated by months of trade wars with China. The battle hurt business investment, threatened the economic expansion. Now, the strip was fueled by job gains that unexpectedly picked up steam late last year, bucking forecast for slowdown. Downside risks had erased somewhat as the Fed lowered interest rates. And, of course, Brexit here. Here are 5 trends in U.S. economy to watch. Labor stepped down. The job market outperformed projections at the tail end of the year, with unemployment matching a half-century low, wage pickups, particularly among average non-supervisory people. The gains were approaching a 4% strong payroll gain in November at 266,000 was enough there. But anyway, that included actually GM workers going back to work. The narrative could weaken a bit with payroll revisions due in February. That will make the past look less shiny. And the analysis reckoned that the downshift will still come in 2020, with an average monthly job gain slipping in Q3 as the pool of available workers shrank. That suggests 2020 will be the year when the Phillips curve is really put to its test. We've talked about that in past episodes, the Phillips curve. Consumer engine, if it cools, the labor market alone is likely to continue sustaining spending on goods and services. The real estate sector in particular is primed for a strong 2020, thanks to lower interest rates after dismal 2018 and somewhat extended into 2019. Building consumers are optimistic, permits are rising well, while the manufacturing sector appears to be emerging from contraction that lasted 2 quarters, actually 3 quarters. For one, the demand will take time to recover on that, no doubt about it. Strong dollar will continue. Been some controversy about it. Shaky states. Now, we've been looking at states now. This is one of the biggest problems. It's sort of like in political polling when we start looking at swing states and state polling as opposed to, say, where candidates are ahead on national polling. While the national level data may remain solid, states that could run hot, it could run cold. What happens in local economy is the key to 2020 presidential election. That means factory jobs in places like Michigan, Pennsylvania, and Wisconsin are likely to get outside attention, and changing demographics along with influx of transplants in once reliable stronghold like Texas. That's changing things there. Risk looms in the shadow of 2020 overlooked for study group. Debt is one. Former Fed officials amongst those warning the danger of prolonged period of ease policy. That's true. A lot of debt has advised there. And the probability of reinstallation of trade war with China. Well, probably not at this point in time, but with others, Brexit looms much, much larger. Another risk factor is in wages and gains that could accelerate more forcefully and finally feed into inflation. Inflation is one of the things not talked about, but it is out in the more volatile sectors when we look at food and gasoline or petrol. I think nationally it was gasoline was pegged at $2.50 or $2.50 plus a gallon during the holiday driving season. Let's go look at the stocks here, and we'll start by looking at this. We'll get this information from Bloomberg. I will start in Europe, and we'll see where we are, and let's see what we got going here. The euro starts at 24 point. Wait a minute here, just a minute here. Okay. These are year percentages here. It was at a negative 8.5. The year it was up at 24.83. The FTSE of 100 was also, where were they? at negative 19.19. For the year, they were up 12.44%. The DAC, a negative 888.10. And for the year, they were up 25.48. In France, 0.03%. And they were also up 26.40. In Spain, they were up 11.93% year over year. And on the net change, they were at negative 50.48. Hopefully I'll do a little consistency here. In France, they were actually at 1.69. So let's go to Asia now. The Nikkei was at negative 181 and negative 181.10. Okay. And year over year, they were at 18.20%. That's what they were up. In Tokyo, we also have the Topi. Well, we won't get to it. We'll do the Hong Seng. We're at a negative 129.64. And a year, they were up 9.07% there. In Shenzhen, I think Shenzhen, 14.51. And some of the Asian indexes here I won't give. Let's go to the Dow. They were at a negative 183.19, and year over year at 22.01% there. The Nasdaq was at the percentage change there was at negative 60.62, and it gained 34.82% year over year. The I think we gave the S&P, yeah, we did. That was at 28.5, and if we look at the Dow, its value was 28,462.14, and this was incidentally on the last year 12/30, the next to last day 19 estimate there that we have from Bloomberg. I think it'll turn out to be basically about the same. If we look at, let me look over here, Reuters. Actually, we use it many, yeah, this is, we already gave a 10-year bond. And let me just take a look here. So we basically rounded up the numbers as they are. And let me just check here. Okay. We won't get into football teams here. But as we, we're getting a little over. Sorry about that. But nonetheless, as we wind this down, 2019 was a year of both headwinds and upwinds. The rate of unemployment basically stayed about the same, 3.5, around that era there. And what happens with, especially with unemployment, it becomes after a certain point in time a normalization of the figures. We don't look at it as much. Now, as far as the real number, the U6, I think it's called, anyway, the real number, close to 7%. That's actual. We really don't get the actual number of unemployment because part of the problem is that the way it is set up after initial 26 weeks or so, a worker fades out of the database. Of course, they put long term. We'll get some numbers on that. And workforce participation rates around 60, a little over 60, has been the number for a very, very long time. So we see that, and then of course we get the gains there. 3.5, 4% gains for some. Federal workers got, what was it, 3.5, I believe it was, raise, the largest raise they got in 10 years, 12 weeks of family leave for most federal workers. That came out of the budget agreement. But however, for pensioners, only like 1.2% there with the Social Security system. So again, some people lucked out more than others. But when we look at the states, we did a report on that. We looked at the states and saw where the individual states are. Many of the states, their rate of growth was around 2%, some slightly less than 2%. We look at that very, very critically, and the number of people being laid off. For instance, this is across the U.S., 8,000 journalists were laid off or made redundant. Cutbacks across those sectors. And, of course, now we have out in Seattle and in Wichita and those places, the 737 MAX is idle. That production line will close this month. The workers will still stay down in Renton. They'll stay down there. I mean, they'll stay on the payroll, but we'll see how that works out. That problem at Boeing, or Boeing's as we call it when I live in Seattle, will continue on. In other words, that will not necessarily mitigate itself, and redundancies will be there in that supply chain. And then, of course, state, local, and federal government spending has not been as robust as it has in the past. Another sign of more of a generalization there. So we'll see a lot of that. The term that is used in many of the PCIs, and we've got more to a regular type economy. Things have not really changed there, but overall, the economy is in a what we term a transitional situation, where the consumer has pulled back, and we'll see more of that pull back, and a lot of that will depend. And we don't have, as of yet, the debt figures out here. And let me just take one look here at the PMI. I won't spend very much time on it. This is the Russian service PMI. I'll just quickly give the overview of it here. Pace of growth eased to a 4-month low. This is in the Russian service PMI. The ISH market Russian service PMI activity index. They did end of a posting of 53.1 for 2019, so not as bad as it could be. From the economist there, Syed Jones, business activity growth lost momentum at the end of 2019. Greater competition reportedly weighted on upturn, with business reining in their hiring activities in turn. Most intense competition all resulted in service providers struggling to pass the high costs to their clients. Composite levels of further deterioration in manufacturing performance and less robust demand. The conditions across private sector there, as a result, business confidence dipped to its lowest since August of 2017. GDP growth for the final 3 months of the year is expected to ease, with current forecasts pointing to year-over-year rise of 1.5%, down from 1.7% recorded there. So that is where the Russian PMI service index was not spectacular growth there. Private sector firms registered further rise in employment in December, driven by greater workforce numbers in service sector. The fractional increase helped to reduce pressures on capacity. So, in other words, there's some look across various countries here, Russia being the last we looked at, and China. There's moderate. In other words, the moderation is the key across the globe. The exception to that will no doubt be the UK or the United Kingdom, and Brexit, as we start to see what will be happening with Brexit. Stay tuned for that. Nonetheless, happy New Year to everyone out there. And from us at the Numbers Man Show production and at Cranston Analytics, we look forward to 2020. Good day.